fund regulation could be on the way. One hedge fund investor tells us, advisor, I should say, tells us what he told the Senate Banking Committee about the subject. That's next on Bloomberg Market Movers. The Hennessee Hedge Fund Index trailing the S&P 500 this year, proof of what's been a mixed year in the hedge fund market. Now, joining us to recap hedge fund performance and share his outlook for the $1 trillion plus industry is Charles Gradante. He is managing principal at the Hennessee Group. Hennessee Group is an advisor to hedge fund investors. Thanks for joining us today,
Monica.
Charles. Hi. Let's talk a little bit about this because when you look at it, the S&P is running to a 6-year high. So I want to get your sense about the market and where the hedge funds are fitting in to this run, really, that we've seen in terms of a reckoning. You said you wouldn't be surprised if we see a pullback right around here. Why?
Well, look, the S&Ps had 5 straight months of going up, so we're due for a correction. I wouldn't be surprised if we see a 5% correction, and that's when I think hedge funds will overtake the S&P. Right now, the S&P is up about 10%. Hedge funds are up 8%, and once a correction hits the market, I think hedge funds will make up for the difference.
Let me get your sense as to why. I mean, are hedge fund managers cautious now? And if that's the thinking, why are they cautious?
They're always cautious because they have this short component to their portfolio. But they're a little bit more cautious now than before because we've had a very big run and there hasn't been any correction. So we're about due for something. And the market is being set up for some news to come out to give it a pullback. There are problems in the credit default markets. That is a big concern.
That's right. That's something that you've been watching very closely. Is that what that's the biggest risk, I should say, to hedge funds?
Well, the biggest risk that hedge fund managers see now to the market is credit default spreads widening and causing a shock to the equity market. Right now, credit default spreads, and that is the spread of, say, the Merrill Lynch high yield bond over the 10-year, is at 8-year lows. So this spread should pop up as it did in 1998 when long-term capital had its problems. A lot of sellers of credit default swaps are going to take a hit in their mark-to-market, and this is a big concern.
How likely is that, though? I mean, is there something out there that people should be?
It's not something that we expect to happen near term. It may never happen, but it is a situation that everyone is gearing up against now. What the expectations are is that credit spreads will widen. They cannot stay as narrow as they are now. China is diversifying their central bank dollar reserves out of the dollar to other currencies, which will mean most likely that the dollar will weaken and the yield curve will steepen. When that happens, credit spreads should widen. So a lot of equity hedge fund managers are buying credit default swaps, playing the widening of credit spreads.
If that doesn't happen, though, does that sort of upset that particular area?
Well, it'll be dead money. If spreads continue to narrow, which they did this month. Credit spreads narrowed, came in about 3 basis points. They could lose money, but we don't see credit spreads narrowing too much further than where they're at now. So the bet that spreads will widen is a good bet. The issue is, will they widen on a catastrophe type basis with long-term capital, or will they widen slowly? If we have a slow widening of credit spreads, the markets will remain stable. If we have a rapid widening of spreads, the market could have a shock.
Is that your gut is the latter is more likely? Slowly
is more likely, except, we had a GM problem last year, which disrupted the market tremendously. And if we have anything near that, it could create another problem because we've had $16 trillion of additional credit default swaps added to the market this year.
What about the climate of raising capital? What has that been like for hedge funds?
Money's coming into hedge funds, especially from institutions, because the stock market looks good. But investors that are familiar with hedge funds would rather invest in hedge funds than the long-only side because they want the protection in case there is a correction in the market or an event like an oil crisis.
Just quickly, what about regulation? I know we teased the fact that you've been, you did testify before the Senate Banking Committee. I testified
before the Senate, Senator Shelby, and I made several points that I think are still valid now, especially since registration of hedge funds is off the books. Number one, accountants, and many are doing this, but not enough, should be divulging more disclosure on counterparty risk on audits that they put out for hedge funds. Number two, lawyers should do background checks on hedge fund managers. Number three, commercial banks and prime brokers can report to the Fed leverage that they're extending to hedge funds. And number four, monthly net asset value calculations. If we do those things, we can reduce fraud and increase our knowledge about hedge fund risk.
All key. Thanks so much, Charles. Gradante, Managing Principal at Hennessee Group. We'll be right back.